Are you sure that you are claiming VAT properly when filing for income tax returns? Many VAT registered businesses think they are until KRA sends them an additional tax assessment notice. And the simple mistake that they make is the confusion whether to exclude or include VAT on expenses or VAT on sales when they are computing for income tax returns. And this is the golden rule that I want all of us to understand, that if your business is dealing with VATable services, always ensure not to include VAT on sales or to include VAT on expenses when preparing for income tax returns. The reason for that is because VAT is not money for your business. It is money for the government of Kenya. You are only collecting VAT on behalf of the government, and you should remit it to them at the end of the day. So be guided. When preparing income tax returns, only use sales that are exclusive of VAT, and only use expenses that are exclusive of VAT. In short, use net amounts when preparing for income tax returns. The story about VAT activities, leave them and use them when preparing for VAT returns. But when you are preparing for income tax returns, only use net amounts. I've seen the mistakes that many businesses make. Mistake number one is when they use VAT inclusive sales when preparing for income tax returns. An example, let's think of a consulting firm that charges 1 million to one of its customers, and they include VAT of 16% over and above the 1 million. So the VAT inclusive invoice is for 1,160,000. But now the mistake that they make when filing for income tax returns at the end of the year, they use 1,160,000 as their sales, but they should only have used 1 million as their sales. So that simple mistake inflates, increases, exaggerates their sales by whooping 160,000. What that means also is that their taxable profit will increase by 160,000, and consequently their tax payable will also increase. Now, apart from paying more taxes to KRA because of that mistake, something else will happen. KRA will notice a mismatch between the total sales that you have reported when reporting for income tax returns and the total sales that you have reported as a business when making VAT returns. The two should match. But because you have made a mistake when filing for income tax returns, they will not match. And KRA will notice that inconsistency, and they will think you are dishonest, and you will be given an additional tax assessment. Mistake number two that companies do make with reference to VAT-related transactions is that they claim expenses that are VAT inclusive. Let's speak about and think about the same company consulting firm that we have discussed about. Is that, let's assume that they also incurred an expense of 300,000. And this 300,000 expense was subject to VAT of 16%. And 16% of 300,000 is 48,000. So total purchase value in VAT is 348,000. That is what they paid to their supplier. Now, when it comes to computing income tax returns, this consulting firm is only supposed to use an expense of 300,000 and not 348,000, because this 48,000 should be with when making returns for VAT. And the 300,000 is the actual expense that this company paid to the supplier. The 48,000, when you are doing output input VAT transactions, you will recover it there. You will claim it there. So for income tax, you use 300,000. If you use 348,000, you are double claiming that expense of 48,000. And by doing so, you are exaggerating your expenses. And consequently, you are underreporting your profits. And KRA will notice. And when KRA finally notices, what they will do, they will disallow that expense of 48,000. And of course, it will not be for free. They will also penalize you. You will also be fined. And because this might happen later on, that penalty might have attracted some interest. Now, to avoid all that drama, by now we understand that when you are making and preparing for income tax returns, use net amounts. Leave alone the VAT-related transactions. Those ones, deal with them when filing for VAT returns. To avoid those costly tax assessments from KRA, always ensure that you reconcile your VAT returns with the income tax returns. The sales for VAT returns and the sales for income tax returns, they should agree. If they don't agree, KRA will notice a gap. And when they do that, they will issue you with more taxes, penalties, fines, and interest. So if you're not very sure about how to go about this, ensure to consult a tax consultant, and you will be guided properly on how to navigate this challenging, complex tax landscape that we have here in Kenya, and more so when you are dealing with the VAT transactions. VAT can be an asset to you, and VAT can be a liability to your business. Let it be an asset to your business.